Welcome to The Deep Dive, the show that helps you cut through all that information noise and get clear, actionable insights. Tailored just for you, really. This is a two-part analysis focusing on South Indian Bank. In this first part, we're going to take a deep dive into their financial performance, their strategy, and what the future might hold. Based on our analysis of the recent Q1 results, we're going to unpack the bank's operations, strategic moves, and financial health, basically giving you the key insights you need to be well-informed.
And, understanding the fundamentals of a bank like South Indian Bank, especially one with such a long history, it really gives you a fascinating window into the broader economy. It's pretty crucial for anyone curious about how these institutions manage growth and risk and what that means for, the economy or even your own financial choices.
Okay, so let's begin. Our first piece of analysis really sets the stage, giving us that bird's-eye view of South Indian Bank's business. Established way back in 1929, so they've been around a while, they talk about next-gen banking now. That seems to mean using digital tools, data analytics to, offer better, more efficient services. As of Q1 this fiscal year, they've got a pretty big physical footprint. We're talking nearly 1,000 branches across 26 states and 4 union territories, plus over 1,200 ATMs and CRMs, and they're serving about 8.1 million customers. That's quite the reach.
Yeah, and what really jumps out from their highlights is this focus on a diversified loan book. They're deliberately spreading things across retail, MSME, and what they call high-quality corporate segments. It really suggests a thoughtful strategy, balancing that growth ambition with risk management. Definitely not putting all their eggs in one basket.
Right. And they also put a strong emphasis on asset quality and collection efficiency, which, as you know, is just vital for any bank stability. They also mention a well-distributed deposit base, stable cost of funds, and really leveraging digital channels for efficiency. Now, here's where it gets really interesting, especially if you're involved with businesses. There's strategic initiatives for MSMEs. They've really beefed up their support here. We're talking dedicated relationship managers, sales managers, even sales incentives for their front-end ECG team. They're strategically focusing on specific sectors too, and they've got a skill-building program for their MSME teams focusing on quality and customer experience, plus tech-enabled renewals, trying to make account management smoother, and a revamped ML product that's machine learning, using data for better risk assessment, more targeted lending, trying to get that competitive edge. And they've empowered branches to handle smaller MSME loans faster with tech support. Oh, and they modified their GST Power product. That's a loan tied to GST returns. They increased the max loan amount there from 2 crore rupees up to 5 crore.
That specific increase in the GST Power product limit, that's a strong signal, isn't it? It suggests confidence in that MSME segment. Maybe seeing more demand for larger loans could be a nice income booster for them. Stepping back, though, all these MSME initiatives show a clear push, targeted growth, better customer experience in a really crucial economic segment. So this raises an important question. How will these operational shifts actually translate into financial performance? How quickly?
Exactly, and that's what the Q1 numbers start to hint at. Beyond MSMEs, they're also working on portfolio resilience, branch productivity, cost optimization, growing non-branch distribution, partnerships, and strengthening controls and compliance. A lot going on. So how do these moves translate into the hard numbers? Let's look at our next piece of analysis, the financial highlights for Q1 FY2025-26, starting with profit after tax. PAT, it came in at 322 crore rupees. Now, that's up 10% year-on-year compared to 294 crore in Q1 last year. It's a decent growth there. But it's also important to note it was down 6% quarter-on-quarter from 342 crore in Q4 of the previous fiscal year.
Right. And while that year-on-year growth is positive, the quarter-on-quarter dip in PAT, it warrants a closer look, doesn't it? Especially at the underlying revenue streams. It hints maybe at some pressure on core lending, perhaps offset elsewhere. It paints a bit of a dynamic picture for profitability this quarter.
Absolutely. Now, looking at lending activity, gross advances reached almost 89,200 crore rupees. That's up 8% from about 82,580 crore a year ago. Healthy growth. And disbursements, the actual money lent out, that saw a really big jump, up 36% in terms of average advances growth, from roughly 32,500 crore last year to over 52,300 crore this quarter. That signals quite an acceleration in business. Deposits also grew solidly, over 112,900 crore rupees, up 9% year-on-year. And retail deposits make up the vast majority of that at almost 109,400 crore.
Yeah, connecting this to the bigger picture, that growth in both advances and deposits definitely suggests healthy business expansion. Customer confidence seems okay. However, let's look at the core profitability indicator, net interest margin, or NM. That's really the engine, isn't it?
That's right. NIN was 3.03% in Q1. Now, that is a decrease. It was 3.26% in Q1 last year and 3.21% just last quarter.
And that NM decline is crucial. It directly hits profitability. Think of like the spread, right? What the bank earns on loans versus what it pays on deposits. When that shrinks, it could mean their cost of funds is rising, or maybe lending competition is forcing rates down. Either way, it squeezes the core margin.
They also reported return on assets, ROA, at 1.01% and a return on equity, ROE, at 12.41%, mostly stable or slightly down compared to previous periods. And net interest income, NII, which is mainly driven by that NIM, came in at 832 crore rupees. That was down 4% both year-on-year and quarter-on-quarter.
But here's what's fascinating, and it really compensated for that NII dip, the surge in non-interest income. That jumped to 622 crore rupees, up 47% year-on-year and 9% quarter-on-quarter. And looking into it, this was massively driven by Treasury and Forex income, up an astonishing 848% year-on-year. That really helped boost the overall operating profit.
Yeah, that boost resulted in operating profit hitting 672 crore rupees, up a healthy 32% year-on-year. And this also helped improve their cost-to-income ratio down to 53.8% from 60.6%. So what does this all mean for you? Well, it paints a picture of a bank kind of navigating these shifting revenue streams. Non-interest income played a really big role this quarter in propping up that operational profit. Okay, next up, let's shift focus. Our next piece of analysis looks at something critical for any bank: asset quality, specifically non-performing assets, NPAs. And the news here is quite positive. The analysis shows a significant reduction in gross NPA, or GNPA, down to 3.15% in Q1 from 4.50% last quarter, also slightly better than the 3.2% last quarter. Similarly, net NPA and NPA improved quite a bit, down to 0.68% in Q1 from 1.44% last year, and they highlighted that this is now below pre-COVID levels.
That is a very strong signal. If we connect this to the bigger picture, you don't usually see such a substantial drop in NPAs just by luck. It generally points to better loan recovery efforts and, maybe more importantly, improved underwriting on the newer loans. Their focus on asset quality is clearly paying off. You can see the results.
And here's where it gets really interesting, I think. The bank has churned, basically replaced or repriced, about 81% of its entire loan book since October 2020.
Right. And why does that matter? I mean, why is churning so important here? Because, and this is critical, 88% of the current bad loans, the current GNPA, is actually from the old loan book, the stuff originated before October 2020, which is only 19% of the total book now. The new book, that massive 81% churn since late 2020, has a remarkably low GNPA of just 0.48%. That suggests the newer lending is significantly cleaner, much healthier. It's a huge difference.
A massive difference. It really highlights a shift. Okay, moving on. Our next analysis touches on provisions the money banks set aside for potential bad loans. Here, we actually see an increase. Provisions and contingencies went up to 239 crore rupees in Q1. That's up from 113 crore a year ago, a 112% jump, and also up 7% from the previous quarter.
Now, what's fascinating here is that while provisions increased, which might seem a bit counterintuitive given the improving NPAs we just discussed, it actually aligns perfectly with a stronger provision coverage ratio, or PCR. It's a sign of prudence.
Exactly. The analysis points that out. The PCR, including write-offs, improved to 88.82% in Q1, up from 79.2% last year. And PCR, excluding write-offs, also improved to 78.93% from 69.05%.
So connecting this to the bigger picture, a higher PCR means the bank is building a bigger cushion, setting aside more funds to cover potential future losses. It strengthens the balance sheet, provides a buffer against shocks. It's really a sign of prudent risk management, building that safety net.
Right, prudent indeed. Okay, next piece of analysis gives us a glimpse into preventing new bad loans and collecting existing ones. We're talking slippages and collection efficiency. One indicator here is SMA2 special mention accounts too. These are loans 61 to 90 days overdue, kind of an early warning sign for NPAs. As percentage of advances, SMA2 actually decreased. It was down to 0.5% in June 2025 from 0.7% in June 2024.
And that raises the question, why is SMA2 important? Well, like you said, it's that early warning. Fewer loans flashing that warning light. A decrease suggests fewer loans are on the verge of becoming NPAs. So better underlying health in the loan book. It's like fewer check engine lights are on. A good sign.
Definitely a good sign. And the analysis also shows fewer new growth NPA additions, down to 192 crore rupees in Q1 from 346 crore a year ago, plus deductions from GNPA recoveries or write-offs were around 185 crore rupees in the quarter.
What's fascinating here is how these numbers, taken together, they really underscore that strong emphasis the bank has on asset quality and collection. Fewer new bad loans popping up, combined with effective recovery, Yeah, that's a very positive combination for their operational health.
I mean, finally, our last piece of analysis brings us to the loan book itself, its composition, its resilience, and where the growth is actually happening. Let's unpack this. The bank highlights a diversified loan book. Roughly 58% comes from segments other than big corporates. Specifically, you've got business loans at 14%, agriculture at 17%, and the personal segment making up a pretty big chunk at 27%.
And connecting this to the bigger picture, diversification like that is key, isn't it? It reduces concentration risk, makes the bank more resilient if one particular sector hits a downturn, spreads the risk out, it's just more stable.
And speaking of segments, the personal segment showed really robust growth, up 26% between June 2024 and June 2025, reaching over 24,000 crore rupees, if you break that down. Housing is the biggest piece at 35%, then retail gold at 20%, mortgage 13%, vehicle 9%, and personal loans also at 9%. And here's where it gets really interesting on growth. Home loans grew by a whopping 66% year on year, and auto loans up 27%. Gold loans, including the agricultural part, also grew by 7%. That housing growth is quite something.
It certainly is. And that raises an important question, doesn't it? While that strong personal segment growth is great for demand and revenue, you also have to consider the risk profile of those rapidly growing segments. How well are they managing the risk as they scale up so quickly, especially in housing and auto? That'll be key.
A fair point. Now, shifting to the corporate loan book, the analysis notes something impressive. 99.7% of it is rated A or above as of June. That's very high quality. Standard large corporate advances loans over 100 crore rupees. Those increased to about 37,100 crore. And finally, MSME loans. They mentioned this is primarily a high-yield portfolio totaling around 12,660 crore rupees.
What's fascinating here, I think, is the bank's ability to grow those key personal segments while, at the same time, maintaining really high quality in the corporate book and focusing on higher-yield MSME loans. It reflects sort of strategic balancing act, doesn't it? Balancing growth with risk. And it clearly shows you where they're placing their bets for the future.
So let's quickly recap the key takeaways from this deep dive. Based on our analysis of these recent Q1 results, we've seen South Indian Bank has a wide reach, a clear strategy focusing on areas like MSMEs, and a diversified portfolio. Financially, it was a bit of a mixed bag. Some metrics softened, like NIM, but others, like operating profit, were helped significantly by non-interest income. Critically, though, we saw major improvements in asset quality. That difference between the old and new loan books is stark, and it's all underpinned by a growing loan portfolio.
Yeah, in essence, based on our analysis of the recent Q1 results, you're looking at a bank that's actively reshaping itself. It's improving its fundamentals, particularly asset quality, and focusing on sustainable growth, even while navigating some shifts in its core profitability this quarter.
Which leaves us with a final thought, perhaps for you to mull over. Considering that clear difference between the performance of the old and new loan books, what implications does this phased improvement really have for South Indian Bank's long-term stability and its growth path? It's definitely something to keep an eye on. We encourage you to keep asking those questions and keep exploring.